Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we help you understand all the closing action of the stock markets today. We'll also help you see which are the sectors and the stocks that are buzzing in trade today, and we will get expert views as to how should you be really approaching the stock markets as of now and where can maximum returns be also generate, the sectors that you should keep on top of your radar. But first up, a quick check of the markets right now. We've been seeing a very choppy session through the day. Even now, as we speak, 62,104 is the level at which the Sensex is trading at, down about 77 odd points. The Nifty is down by just about 10-12 odd points, absolutely flat with a negative bias, 18,484. That's the level at which the Nifty is trading at. Also, the broader markets, if you take a look right there are some bright spots, especially the small cap 100 index. That's picked up pace today. 0.4% of an uptick can actually be seen. The mid caps are selling into the kind of move that we've seen in the broader markets, in the major markets as well. Down about or just absolutely flat. The Nifty mid cap 100 index is at 0.06%, absolutely flat with a positive bias right here. Among the other sectors, you're seeing some action coming away as far as the PSU Banks are concerned. That's actually leading the pack today. Over a percent gains can actually be seen for that one. The metals are slightly up in trade, but they've also come off the high point of the day. The royalty stocks are also seeing some selling off. 0.3% of an uptick still remains, although it is in the positive trajectory. But what is really dragging the markets today? Clearly the IT pack, that's now down almost a percent at the day's low point of the day. The FMCG stocks are down by 0.25%. The pharma stocks are also seeing some kind of cuts. 0.3% of a downtick can be seen on that one. The autos are driving the slower lane. So you are seeing a divided and a mixed trade really. But what is also noticeable is that the declines have actually seen an uptick right there. 29 declines of the Nifty 50 stocks and 21 advances at this point in time. So more stocks in the red. Talk about the Nifty losers at this point in time. The top loser is Asian Bains with 2% cut right there. Eicher Motors down by 1.5%. Infosys, Titan and Sun Pharma, the other drags at this point. When you talk about the Nifty gainers, there is Divis Laboratories that is seen on top of the charts, about 2% up in trade. Coal India has moved up by 1.5%. IndusInd Bank, ONGC and Tata Steel, the other gainers. So the oil and gas pack clearly is looking up at this point in time amid the fall in crude oil prices as well. Let's welcome our guest for the day. I'm now joined by Sanjay, Sinha, founder of Citrus Advisors. Welcome, Sanjay, and thank you so much for taking the time out. I want to understand from you, Sanjay, what is your own sense of the market right here? We've been seeing a range-bound trade in the last 2 weeks or so after the Nifty really touched that record level. Beyond that, do you really see that the markets are at a cautious point, or are you going to be deploying more funds in this market?
So I think, to understand the market, you will need to distinguish between what are the secular trends and what are the tactical events which are happening around you. I think on a secular basis, a couple of things which are happening, I think, are putting us into a long-term bullish trajectory. And the number one factor in that is the fact that, the per capita income in India has now crossed $2,000. Now, empirically, whenever an economy's per capita income has crossed that, you have seen an exponential growth in consumption and also a very rapid advance in the capital markets in those countries. So I think we will not be any different. We will be part of that same empirical evidence that has been there in other economies, and therefore the secular trend number one that is going to happen is going to put us on a bullish trajectory from here. Uh, Now, if you look at the tactical events around you, uh, I would say that rewind back to the last 4 or 5 years, you will find that there has never been a phase where there has not been a flashpoint somewhere in the world or not. Like even before COVID, we always had this issue with North Korea firing their missiles and the market
Yes.
sentiments going up and down. Then we had COVID, which was a major event which lasted for almost 2 years. Then we had the Ukraine war. We now have the China lockdown and the slowdown overhang. So at any point
Absolutely.
in time, these overhangs will always be there. How
Hmm.
do you deal with these events? Are more in terms of sort of synchronizing uh,
Hmm.
the rational expectation versus the market's reaction, and that's how you have to pilot your way. So I would say that we should not lose sight of the secular trend that is building up, and to
Yeah.
the best of our ability, we should try to take advantage of whatever tactical opportunities the market presents.
Hmm. So, what, according to you, will really drive the Indian markets in the year 2023? Will earnings be a focal point, or will it be what the Fed does on the interest rates front?
So my personal view is that it is now an accepted fact that in a world that is confronted with recession, in India we are confronted with the debate as to whether we are going to grow at 7% or 6.8%. So
True.
therefore, we are a beacon of hope for the whole world. So on a macro basis, Indian economy is going to be growing.
Hmm.
Now, the cascading impact of that growth in terms of its impact on sectors needs to be looked at a little more closely. The prima facie conclusion is that the domestic focused industries should do better. The export oriented sectors may face some challenges. I think some of that is already being seen in the markets, in the sense the IT and the pharma pack is
Hmm.
struggling. But many of the domestic consumption stories, and more particularly the unlock themes,
Yeah.
particularly in the hospitality sectors, are doing exceedingly well. I think, given the fact that China is in some way slowing down, the world economy doesn't seem to be growing very fast. The crude prices have moderated. So I think the bigger pain that was witnessed in the corporate performances in the first half of financial year 23 was the
Hmm.
pressure on margins. I think in the second half, and extending up to the first half of financial year 24, the pressure on the margins should now, in my opinion, diminish, and
Okay.
therefore the outlook on profits growth is much better.
Hmm.
So I would expect that if I'm going to be betting on earnings, I
Yeah.
think the likelihood of the earnings growing is much more than the
Okay.
earnings being continued to be under pressure.
Okay. And which sectors would you really see doing well in the next year amid the expectations from the budget, and that comes right ahead, 1 year ahead of the general elections? There is some discussion that there could be some populist measures as well. So amid all of those expectations, any particular sectors that you may be looking at outperforming?
So I'm not too sure about as to whether the budget is going to be really populist or not. But one
Okay.
thing is for sure, that given the compulsions of the general elections and the need to demonstrate performance, there will be many infrastructure projects
Hmm.
which will either be pushed, or at least will be either inaugurated or launched. So I guess that is one sector which I think is a beneficiary of both the fact that the in the uh, situation that the private capex
Hmm.
has not come on stream to the desired level. The public capex is the one which has had to take the front seat. So I expect that there will be a lot more infrastructure spending, and the beneficiaries of that would surely be the EPC, the construction companies.
Okay.
Also, of late, if you've noticed, there's been a lot of activity which is happening in the capital goods sectors,
Yes.
both among the national companies as well as in the multinational companies. So I think these two would be my primary favorites.
Hmm.
Second would be the large ticket consumption item, and more particularly autos. Uh,
Okay.
we are coming out from a long period of, you can say, pent up demand. And if you believe the stories which have been circulating, that there is a 8 month, 9 month waiting period for certain models of car. So
Hmm.
I guess with the launch of new models and the fact that there is a pent up demand, auto and auto ancillaries would be the second pack where I
Okay.
think one can be optimistic.
Okay.
Uh, yeah.
And any sectors where you would be perhaps cautious or would want to stay away from, where you see underperformance in the next year?
So, at this point of time, the jury is still out as to whether the rural consumption has come back on track or not. Okay, there are divided views, opinions, both from the analyst as well as from the management that is coming on this part. So, FMCG is one sector which always goes up and down with the outlook on the rural consumption. So, given that fact, and given the fact that the valuations also are fairly rich, if there is no company specific event which is to the contrary, that would be one sector that I would be a little, you can say, not too excited about.
Hmm.
But having said that, I at the outset said that the export-oriented sectors are the ones which may not do so well. But
Okay.
that is how you build portfolios. You buy when the pessimism is high. So
Okay.
so I would touch upon that later if you want. But I think as a contrarian, one can start picking up, or I would say the better word is start nibbling at the
Okay.
IT pharma.
Okay, understood. IT and pharma. I will discuss more about the ID stocks also going forward from here. But are there any key factors that, according to you, could really puncture the kind of rally that we've been seeing intermittently right now? We are on course to hit newer highs, and most of the analysts do expect technically also that we may be looking at a 19K pretty soon and a 20K thereafter in 2023. Anything that could puncture that kind of a move on the upside?
So I think in the absence of a black swan event, with whatever you are able to see in the perceptible domain at this point of time, I think the momentum is very strong. The domestic flows are also equally good, and though belated, the FIIs are also fairly positive on the Indian market in terms of their flows. So
Yeah.
I think the ground has been set for us to take out higher levels, and you can't also ignore the fact that we always have this year-end rally that normally picks up
Yes. Yes.
towards the end of December and carries into January. So I
Hmm.
guess I would say that it might be a little safer to bet on the bullish side than to be betting against the market now.
Okay, hold on to that thought, Sanjay, and we'll come back to you. My colleague Tanya Aneja right here to share with us some of the stocks that are buzzing in action today, and we should definitely keep all our viewers also abreast of it. Take it away, Tanya.
Absolutely, Sakshi. So let's start with Vatek Wabag first. So shares of Vatek Wabag surged almost 12% today and hit a new 52-week high after Wabag Water Services SRL, that is its European subsidiary, secured a repeat order from Purolite SRL worth 260 crore rupees. Then we have Hindustan Oil Exploration. The shares jumped almost 5% in trade today. The stock in fact ended its 4-day losing streak after the company said that it has resumed oil production from D1 well in its B80 field located in Western Offshore after arresting a leak in the SCSSV control line. Then we have Paytm as well. The shares of Paytm were trading lower in today's trading session, even after the company reported a 150% jump in its October-November loan distribution at 6.8 million, with annualized run rate for the loan distribution business standing at 39,000 crore rupees. Now,
Hmm.
besides this, the company also said that it now has over 5.5 million devices. Next on the list, we have ONGC shares. The shares are also in focus today. So basically, the company proposes to carry out the onshore exploration of 50 wells in East and West Godavari districts of Andhra Pradesh based on the geological and geophysical studies. The estimated project cost for all the three wells would be at around 150 crore rupees, and it would take 3 to 5 months for exploratory drilling at each well site. Lastly, we have Coal India as well. So the stock is among the top gainers today. The company said that it will increase spot auctions of the fuel in the coming months as the company's rising output has left them with enough fuel to meet increasing demand from non-utility power plants. Back to you.
Thanks, Tanya, for that update. Sanjay, wanted to take your view on the oil and gas space. We've seen the crude oil prices ebbing. You've talked about that as well. How do you really see things panning out for this space? Should one really keep focus here on the upstream, or is the OMC stocks going to be seeing in better limelight? Help me understand your view here.
So, the central assumption would be that the crude prices are going to be soft at around these levels. We need not carry the apprehension of crude hitting $135 per barrel or somewhere in that level. So, if that be the central assumption, I think the OMCs are the ones which stand to benefit more than the other segments of the oil company. Of
Hmm.
course, there is also this buzz about the windfall tax being moderated, given the fact that crude prices has moderated. So
Sure.
there could be some short-term reactions to that, but on a secular basis, or I would say on a tactical medium-term basis, the oil marketing companies will be bigger beneficiaries.
Okay. You were earlier talking about the IT sector. We've seen a massive derating right here through this entire year. I wanted to take your view here. We were thinking that perhaps we are near the bottom, but then there were some recent fears again raised by some of the top global brokerage houses that are again talking about furloughs as a fear, or like slowdown concerns, and many-fold concerns really bogging down the IT space. HCL Technologies today said that it expects FY23 revenue growth to be at the lower end of the guidance as well at 13.5%. What is your own sense here? For all those investors holding on to these top majors, what is the correct strategy? And do you think somewhere they're in an oversold zone as of now?
Okay, so if you trace back the recent fall, not the recent fall, the fall in the IT stocks in India, I think it had very little to do with their declining fundamentals and more to do with the changing sentiments in the US. Uh, if you just go and review the performances of the IT companies in Q2 FY23, you will find that they have not given you a lot of room for disappointment. Okay. So I guess the correction in stock prices had largely to do with the way the IT stocks were correcting in the US, and they had a different reason altogether. Uh, on a more immediate basis, these statements which have come out from some of the IT managements about their growth being at the lower end of the growth guidance, that growth guidance itself is in somewhere in the teens. It is not as if they are going to grow in single digit for the next 1 year. So the market's overreaction to this, I think, is a little overdone. Okay. At the same time, while we are grappling with the performance of the IT stocks here and our exaggerated expectations from their fundamental performance, the survey which has been conducted is actually talking about a more IT stocks in the US. So if that is going to happen, I would say if their stock price decline led to the sentiment change in India, if their stock price starts moving, then the sentiments will also change in India. As far as their fundamentals are concerned, I think IT is companies, Indian IT companies have done reasonably well, which is why I said that as a contrarian, it would probably make sense to nibble at the IT stocks at this point of time than to completely stay away from them just because of some of these statements coming out from some of the managements.
So some of the bellwethers would you be preferring, or would you prefer the mid-cap names here?
No, so of course, the large cap IT stocks are the more enduring performers all this while, and I think their capacity to create wealth is not completely over. So they should surely command a significant allocation of your portfolio to the IT sector. At the same time, there are now a significant number of mid cap IT stocks which have started making their presence felt. This they are doing in multiple ways. In quite a few of them, their revenues are now in $1 billion range. The margins at which they are operating are also very significant. The space in which they are operating now are niche, and they remain unchallenged there. So I think now in the mid cap IT also you have a fairly good selection of options from which to
Correct.
pick up your portfolio. So I would say that on a thumb rule basis, a two-third, one-third allocation to the large cap and the mid cap within the IT from the IT allocation would be sensible.
Okay, noted that. Amid the performers now, the banking space is really taking the lead, and how, some of the well-destructing stocks like Yes Bank and PMD are rallying quite sharply this week. Yes Bank up 2%, 20% in just 2 days. Help me understand, how are you analyzing some of the PSU banks move and some of these, private banks now playing catch up in this kind of a move?
Okay, so first and foremost, the rally in the public sector banks got triggered uh, because of their quarterly results. Both on the proportion of non-performing assets that they were accumulating, the trend has now reversed. That was one significant thing. Second was, their margins were expanding. They were anyway always a significant player on the corporate loan book, which is the one which is today seen to be the more important driver for banks. So these things which got disclosed in the quarterly results were the, my opinion, were the primary drivers.
Yeah.
At the same time, if you see the long-term trends of PSU banks, PSU banks always languish for a significant period of time at a discount to their book value.
Hmm.
Then the tide and the sentiments turn in their favor, and then these stocks start rallying. And as typically happens in the market, valuations are never rational. So you will find that they will trade up to their book value and then go beyond their book value. I have seen that in the past many a times. Public sector banks end up peaking out somewhere between 1.5 times to 2 times their book value, somewhere in between that. And that also happens because the euphoria, the momentum, and the participation in the PSU banks then is at a very significantly high level. So today, if you see, most of the PSU banks are either near their book value or even now trading at discount to book value. So and a lot of sell side reports are coming out with some fantastic targets for PSU banks. So I guess
Yes.
the sentiment is going to be in favor of them for some more time to come.
Okay. But do you see private banks catching up? I mean, like the stars of the last cycle, HDFC Bank, Kotak Mahindra Bank, which have now entered into a serious time-wise correction as well. Do you see them springing up anytime soon?
So in the case of private sector banks, what might happen is that while the pecking order in terms of the leadership of the loan book, that may not change, but in terms of price performance, some of the private sector banks which have not been such star performers are now going to be star performers in terms of stock price behavior, because they are also demonstrating a stronger traction in their fundamental performance, in the sense their loan books are growing very fast. You are seeing that their net interest margins are improving, and more than anything else, their CASA traction is also significant. So a mix of many factors is now acting in favor of some of these private sector banks, and and they are across the spectrum, both for the large cap private sector banks as well as for the mid cap, and off late even for the small cap private sector banks. These factors are now in their favor.
Okay. Are you also tracking any of these new IPOs? Uniparts did a tepid listing today. Sula Vineyards has hit this street. And, are you tracking this space actively?
No, not very actively. But I am not very surprised by the listing gains that you are seeing in a large number of IPOs,
Hmm.
because today one of the key things which is, I will say, part and parcel of the Indian capital market is the phenomenally large retail participation. Okay. And given the way the retail thinks, uh, as it is, given the 500 odd pages of the DRHP that most of these IPOs file, people
Hmm.
don't have time to go through them to understand the companies.
Yes.
It's mostly on buzz,
Hmm.
okay, and mostly on the subscription numbers. So, these the IPO market, in my opinion, will remain active. Sometimes you will see a little tepid listing, but in quite a few cases, you've also seen a good listing gains for companies. So,
Yeah.
I've always maintained that the prosperity of the of the primary market ultimately flows into the secondary market, and both of
Hmm.
them are now very closely interlinked.
Okay. But have you visited Nashik Sula Vineyards? Have you been there at all?
Yeah, on a personal level, yes.
Okay. And but would you be a buyer here or not at all?
So that would be difficult for me to comment.
Okay, understood that. So, as a portfolio strategy, Sanjay, what would you really recommend investors do? I mean, as we head into the new year, where should the money go? How much should be the cash that one must be sitting on? The whole idea of how to approach markets in 2023 as an retail investor point of view.
So I would say that cash is a very tricky thing to have in your portfolio. As a fund manager, it has been my personal experience that
Hmm.
the level of cash in your portfolio does not help you either in a rising market or in a falling market.
Hmm.
But your stock selection is the one which is more important. So,
Hmm.
there have been many instances in which I have carried 10% or more cash, but still my portfolios have performed because the stock selection was probably better than what the market was betting on.
Yeah.
So as we get into 2023, my advice to a typical retail investor would be that 80% of his allocation should be to managed portfolios, in the sense that he should look at equity as a means of wealth creation, and 80% of of that wealth creation responsibility should be given to a professional. 20%
Okay.
is the only portion that they should manage on their own, and for that they should cherry pick stocks which they understand, on which they can take a tactical as well as secular bet, and that is what should be the proportion that they should have in their direct portfolios.
Okay, so for a millennial investor who has been, investing in this last 2, 3 years, has entered this world of stock markets right there, what would you really say are 2 or 3 things that you perhaps look at cherry picking stocks? How do you select stocks so that they can get an idea of, what is the right way of picking a stock?
So one of the first thing that they should do is avoid the herd mentality. Okay, in the sense that if you go back and look at India's capital market history, the three major accidents that we have had was in 1992, 2000, 2001, and then again in 2008. In all these three instances, there are two things which are common. One, the market fell by almost 50 to 55% from the peak levels that it had gone to. And the second thing is the one which is more important. In all these three instances, the entire focus of the market had converged to a particular sector or to a particular theme. In 1992, the market had completely converged to the stocks, which was championed by Harshad Mehta. If you look back at 2000, 2001, the entire market had converged to the IT sector. If you look at 2008, the majority allocation had gone to infrastructure. So this herd mentality resurfaces time and again in different forms. So the first lesson that people should take is that they should avoid the herd mentality and chase only one theme or one sector. The
Okay.
second thing that they should do is that there is investment is a very boring sort of thing. You should avoid being very flashy and try to back companies which you don't understand. I don't think there is any harm in backing a biscuit company if you know biscuit as a business, or there is no harm in backing, say, a tire company or an automobile company. I'm saying that instead of putting your money into a business which you don't understand, it is not a good idea. You should
Yeah.
either leave it to the professionals or only invest in businesses that you understand. And thirdly, is that you should have rational expectation. If you want your money to double every year, then all the decisions that you will be taking will all be focused on that number. I would say that uh, the world acknowledges that it is very difficult to beat the market. If you have been beating the market, I would say please stay happy that you are doing it by a few percentage points. But if you are expecting to beat the market by a very wide margin, you either have to be very lucky, or you are smoking something that all of us need to know what it is.
Okay. Well, on that note, thank you so much, Sanjay. It's been a pleasure speaking to you as is always, and hope you have a great investing time. We shall catch up very, very soon to understand more about markets as we enter the new year as well. Many thanks for tuning in and joining us on Business Today TV. Let's quickly look at how the markets are closing at this point in time. We'll do a quick wind down. The Nifty is at 18,495, absolutely flat, and the Sensex is at 62,147, down 33 points. 0.05% of a downtick is what you can see. Perhaps this is the closing level for you. Another day, I mean, like we started this whole week on the red note, that is. Talk about the other sectors as well. Let's see where the, declines have come into. The Nifty Bank also has shut shop, absolutely flat. It was up in the green in today's trading action. It's just managed to end up absolutely flat with just 1.15% of an up move right there. But you can see, apart from this, the broader markets, let's look at how they have shut shop. The mid-cap and the small-cap 100 index, as far as the Nifty 100 mid-cap 100 index is concerned, it's up by 0.4%. can just see that last one half an hour move at 3 o'clock, we've seen that uptick coming about. 0.5% uptick for the small cap. They both ended at the day's high point of the day. So the broader markets have seen participation coming in at just that 3 p.m. move. I was really hoping, when we started off this show, we started to see some green ticks coming in from the FMCG pack, for example. The FMCG sector was in the red throughout the trading session, but we saw that slight move up into the green. There you can see it. We've seen that 3 p.m. move, sharp uptick right there. Some of the stocks must have pulled up quite sharply over there in the Nifty FMCG index. So that I thought that perhaps could pull the index into the green, but it failed to do so. Some of the other sectors that have been not performing today, the IT sector, let's see where that has closed, because that was one index that was down from the word go today. Almost 4.5%, 0.4% of a downtick right there. But you can again see that 3 p.m. up move that we've seen the recovery from the low point of the day as well. So 29,050 for the Nifty IT index. Let's see how the PSU Banks have shut shop. That was one index that was really shining bright despite the overall muted sort of a trade that we've seen today. 1.4% up at the day's high point as well. That index has definitely performed to the T, as it has been over the last few trading sessions as well. The private banks also coming in tow, slight green on that one as well, and the financial services as well in today's trading action. But what also has not performed in fact is the pharma index. That's declined today. Apart from the IT space, from the defensives, that's down by 0.13% as well in today's trading action. Well, it's the advances that are higher. As we end the day, 28 advances to 22 declines as far as the Nifty stocks are concerned. Let's look at the top gainers, for example. BBCL, that stock really shot up towards the end of the session, over a 3% uptake as the top gainer. Apart from this, Divis Laboratories was up 2%. It held fort through the day today. Coal India up by 1.5% as well. UPL and Nestle, apart from that, Apollo Hospitals as well, up by over a percent odd for these top gainers as far as the Nifty index is concerned. When you talk about the losers today, you will find that Asian Paints was down and out. In fact, 2% down. 3166 rupees is what we were seeing it that trading at. Infosys, Kotak Mahindra Bank down in trade. Titan also seeing some cuts right there of over a percent. Eicher Motors and Cipla all were down in trade. So some auto majors, some consumption stocks coming in there. The consumption theme really taking some kind of a beating in today's trading action. But we definitely closed the day in the red. We'll have to see whether there is going to be this kind of a range bound and a muted and a cautious stance that the markets will take right ahead of the US Fed's decision that we expect on Wednesday, and therefore for us on Thursday morning as well. And we will also get some of the cues from Bank of England and European Central Bank as far as the interest rates are concerned. But till that time, the markets are likely to hover in this range as well. But will we see a Santa rally towards the end of this month and the end of the year as well is something we'll keep an eye out on. To get all the updates on stock markets and news from the world of business, do stay tuned on to Business Today TV as you'll continue to get more updates here. Don't forget to subscribe to this channel and also stay tuned with us through our other social media platforms. That's also Facebook, Instagram, Twitter, and LinkedIn. Thank you very much for tuning in for now.